The Federal Reserve believes the bank failures earlier this year will push the economy into a recession that will take 2 years to recover from. With a recession looming, should you contribute to your Roth IRA right now or wait? Additionally, if you've already contributed, did you make a mistake? Roth IRAs are the backbone for many Americans' future retirement plans. It's not hard to see why. If you follow the rules, all of your money you make from your investments inside your Roth IRA comes out entirely tax-free. But since the government doesn't want everybody to have unlimited tax-free growth, Roth IRAs have an annual contribution limit. Therefore, you need to make sure every contribution counts. For example, 2023's Roth IRA contribution limit is $6,500. If you were to invest that money with an average annual return of 10% and let it compound for 40 years, you'd have over $290,000 for retirement, all of which is tax-free. But what if you invest your $6,500 and the market tanks, costing you over 50% of your contribution? It would be like you only made a $3,000 contribution that year. That missing money could cost you over $100,000 long term. Before I share the mathematically best market timing strategy for your Roth IRA contribution, let's make sure you thoroughly understand the current economic crisis. When COVID-19 shut down the economy, the Federal Reserve and the government acted quickly to minimize the damage. Thanks to Powell, Trump, and Biden, the economic damage from COVID-19 was brief relative to what it could have been. To illustrate this, let's look at the unemployment rate in the United States over the past 2 decades. Unemployment jumped during 2008 and the dot-com boom, and then slowly recovered over the following years. COVID-19 was different. Unemployment hit a crazy high and then plummeted. Within 2 years, unemployment was back to hovering at record lows. The intense stimulus used to counteract COVID-19's economic damage worked. But just like someone who never brushes their teeth, consequences catch up quickly. The economic stimulus resulted in sky-high inflation. Now, inflation sucks, but it is the lesser evil. Having a deep economic crisis with stubbornly high unemployment during a pandemic would have been horrific. By stimulating the economy, the government pushed some of the economic pain into the future. Dealing with economic pain is a lot easier when a pandemic isn't raging at the same time. While the stimulus was right, it's also fair to say the government went too far. Inflation going up a little bit is fine, but inflation has hit highs not seen since the late 1970s. The Federal Reserve found itself having to raise interest rates at one of the fastest speeds in US history. The interest rate increases are so fast that some banks went under along the way. There is no better example of how this works than Silicon Valley Bank, which was the 17th largest bank in America before its collapse. Silicon Valley Bank was a bank that served tech companies. When the tech industry is prosperous, Silicon Valley Bank would share in the good fortune. But this is a double-edged sword. Over the past year, the tech industry has slowed down faster than the rest of the economy. The tech industry is engaging in layoffs since they hired too many people during COVID-19. Additionally, the tech industry is losing access to cheap cash. Attempting to find the next big innovation is expensive, so being able to borrow money cheaply is very important to tech companies. But the Federal Reserve is increasing interest rates, which makes borrowing money expensive again. Therefore, the tech companies are preferring to pull money from their bank accounts instead of borrowing more cash. Because of this situation, Silicon Valley Bank ran into the issue where most of their clients were pulling money out of the bank. Then social media began spreading fear that a bank run was occurring at Silicon Valley Bank. This led companies to pull money out of the bank even faster. And it gets worse. Silicon Valley Bank invested a lot of their money into long-term treasury bonds. When interest rates go up, existing bonds lose value since new bonds are being offered at a higher interest rate. The withdrawals forced Silicon Valley Bank to liquidate their bond holdings at a loss. Ultimately, Silicon Valley Bank did not have enough money to cover the withdrawals and the bank went under. This story played out similarly with Signature Bank. This bank served the cryptocurrency industry. As Silicon Valley Bank started to fail, the clients at Signature Bank started to pull their money as well. Another bank run, another collapse. To make this all even worse, the bank failures might not even be over yet. As I mentioned earlier, the Federal Reserve will likely need to raise interest rates again. If there are other banks in a similar situation as Silicon Valley Bank was, more banks could fail. Now for some good news. The Federal Reserve believes we will have a mild recession. That's very different compared to the last 2 recessions, which was a pandemic and the worst economic event since the Great Depression. Now a mild recession is still undesirable, so what should you do with your money? Time for the hard truth. This is the kind of truth you don't want to admit, but you will likely prosper if you do. Everything I've said so far is publicly available information. Even with the risk of a potential recession, professional investors have concluded that the current market prices are justified. On top of that, those professional investors are getting input from teams of professional economists who spend 80 hours a week studying the economy. When it comes to the question of whether or not the market is overvalued, you and I are completely outgunned. But here is the good news. There is a market timing strategy that us normal people can use that yields fantastic results. We don't even need a team of economists to help us. To learn this strategy, let's dive into one of the most important financial articles of all time. Does market timing work? This article analyzes the results of 5 different market timing strategies over rolling 20-year periods throughout US history. At the start of each year, $2,000 is invested into the S&P 500 using the following strategies. The first strategy is perfect market timing. The money is invested into the S&P 500 at its lowest price each year. The second strategy is investing immediately. The $2,000 is invested at the start of each year. The third strategy is dollar cost averaging. The $2,000 is split into 12 piles of cash, and one pile is invested at the start of each month. The fourth strategy is horrible market timing. The money is invested when the S&P 500 is at its highest price every year. The fifth strategy is not to invest into the S&P 500 index and instead throw the money into treasury bills. Now let's play a game. From 2001 through 2020, which strategy do you think did the best? You can pause the video, it's okay. Have you got your guess? Good. The answer is perfect market timing. This isn't much of a surprise, since if you're always buying at the lowest price, you're going to be doing great. But here's the problem with that strategy. You can't see the future. If you can, the stock market would look like a joke compared to just picking winning lottery numbers. Luckily for us normal people, the second best strategy, investing immediately, isn't hard to do. You just put the money in the market. Now there are times where the best market timing strategy order changes. There was even a 20-year period where not investing was the best strategy. But historically, there is a clear winning order of the different strategies. In 66 out of the 76 rolling 20-year periods that were studied, the best market timing strategy order was perfect market timing, followed by investing immediately, followed by dollar cost averaging, followed by terrible market timing, followed by staying out of the market. With data like that, you should feel good about getting your money into the market as soon as possible. Let's look at your 2023 Roth Contribution. If you ignored the fear of a slowing economy and put your IRA contribution in as fast as possible into the S&P 500 index, you would already be up 8% for the year. Of course, that doesn't happen every year. However, the start of 2023 is a good example of how getting your money into the market, even in the face of economic ruin, is often a wise move. However, investing is personal, and what is mathematically best isn't necessarily what's best for you. For example, being a stock-picking god like Warren Buffett would yield incredible results. But I don't have that ability, so I don't stock pick. I cater my investing to who I am. Not all investors will feel comfortable putting their money into the market as fast as possible. It's a scary feeling to look in the face of an economic storm and then throw thousands of dollars into the market. If you are nervous, consider dollar cost averaging. Contribute to your Roth IRA over the course of days, weeks, months, or even the entire year. If the market goes down, you'll get a better share price since you still have money to invest compared to somebody who's already invested everything. With that all said, the market does typically go up. That's why we invest after all. If you choose dollar cost averaging, make sure you are comfortable with that. More often than not, you'll be paying a little bit more for your investments. But that can be well worth it if it keeps your emotions under control. To summarize, the best market timing strategy for most people is to invest as soon as possible. Even if the stock market declines this year, you shouldn't have any regret over contributing to your Roth IRA. Mathematically, you made the right decision. If you found this video useful, it would help me out a ton if you'd subscribe. I wish you well on your journey towards financial success.